fundsupermart.com.
And whether the equity markets will be performing accordingly in year 2012 or not. That was my main idea.
See, if you see, that's why I said it's very important that you get convinced about one thing, which is fundamental. If you believe that equity markets are mirror image of what's happening in real economy, and forget 2012, I think you'll get more convinced because of the past history, right? If you see over last 32 years kind of a thing, on an average, India has grown at 6-7% real GDP, right? That's real GDP growth. And obviously you always had inflation problems every 2-3 years kind of thing, because we've never tried to address the supply side issue. An economy hots up, there is demand exceeding supply, creates inflationary pressures, and we would just raise interest rates, suck out liquidity, create demand for next 1 year, and we feel great, wow, we have conquered inflation. And that has never happened. But to the credit, I think the current government actually thinks differently, which is positive for Indian economy. So what I'm trying to say is that's why you had 6-7% kind of an inflation. So nominal GDP growth over last 20 years, 25 years has been roughly around 13-14% kind of thing. If you look at top 100-150 companies over this time frame, because they are highly efficient, they would generally do 300-400 basis points above the nominal GDP growth, right? So that's why you saw that top 200 companies, 150 companies would roughly have grown around 17-18 times, looking at the nominal GDP growth and their efficiencies kind of thing. And that is what markets exactly reflect. What is your last 32 years CAGR return of equity markets? 17%, right? So you will have 3-4 years when markets will give you 40, 50, 60%, 100% returns. You will have 2-3 years when markets will crash by 70, 80% kind of thing. The idea is ultimately, if the markets are reflecting what is happening in the real economy, it will come down to your potential real economic growth, and it will convert that. So if you believe that over next 5-10 years, this economy has the potential to grow at 7%, you believe that you will still have 5-6% of inflation, which makes it 12-13% nominal GDP growth. And if you believe that top 100 and 150 companies, forget about 5,000 companies which are listed in India, it doesn't really matter. Hardly 800 to 1,000 companies trade every day, right? And of that, obviously, your personal portfolio will not have more than 100 companies, right? Even equity funds, if you look at diversified funds, the portfolio would not have more than 50, 55, 60 stocks in the portfolio, depending on the scheme's mandate. So if you believe that this top 100-150 companies over the next 5-10 years has the potential to grow at 14-15%, then that's what the market should reflect. And I think that those are good enough returns and tax-free, because when you're talking about 3-5 years kind of thing, vis-a-vis 5-6% inflation, so investors should be happy with that decision and that asset.